All right, welcome everybody to Tesla Today. So today's topic is all about Tesla stock. Is it overvalued? Is it undervalued? What metrics should we be using to evaluate whether or not Tesla's in a right path or not? We want to know, how does it compare with the other large tech companies and how's it doing? So today we've got Yashu Sharma with us. Yashu hosts his own YouTube channel called HitThatBid. And I've had him on before because he has his model of how he looks at Tesla stock. He also follows the stock market and a financial arena quite well. Thank you so much, Yashu. Thank you for joining me.
Sweet. Thanks for having me on, Herbert.
Love it whenever you join me. So I know that you just got married a couple of weeks ago, and I think you have several events. So tell me what happened.
Oh, yes. Well, briefly, I won't bore people too much with it, but when you get married in an Indian house, apparently it turns from a 1 day thing to like a whole month thing. So I've just been head down. I feel like I don't even know what's happening anymore with the stock market. I feel like I've forgotten everything. It's been that long, but no, it's been awesome. It's been exciting family in town, but I'm glad the festivities are wrapped up now at this point. So.
Okay, thank you. So I'm going to share with folks here this slide here that I saw from a guy named Brian Feroldi. We're going to walk through the various ways that he thinks that which metrics should you be using to evaluate a company, but it depends on where that company is on the stage. If they're just a startup, you only look at just the total addressable market. You don't want to be looking at, discounted cash flow because they're probably not making any sales and so forth. And depending on where the company is, that is the kind of various metrics you'll do. So we'll get here. I'm not going to cover it right now. We'll start off with how Yashu looks at the Tesla to stock. But I think Brian Feroldi says that he sees Tesla being right here in operating leverage. We'll walk through this in more detail, but let's get started with you, Yashu. Tell me about how you are now looking at Tesla, the stock. I had you on last time, and you walked through your kind of evaluation, and then you compared it at that point, deep dive into comparing it to something like an Amazon. So how are you looking at Tesla now?
Yeah, I think so. Whenever you talk Tesla, I think it's important that we distinguish between the different parts of the whole, right? We got Tesla Auto, then we got Tesla Energy, we've got Tesla FSD and the robotaxi network and fleet and the possibility of that. Then now we have more information on Tesla Dojo. Um, but of course, when people think Tesla and on Wall Street, they think Tesla, the auto business, because the majority of the revenues come from there. So when I look at Tesla, and actually here, I'll share my screen here if I can, with just my back of the napkin update, right? And this is just the auto business. And I think it's important for us to distinguish between, okay, what is factual today in terms of hitting the bottom line, and what are the future possibilities of earnings coming from Tesla. So just the car business in and of itself, and there's a lot of numbers here, but I'll walk you through what's important. First, we have to start with how many cars we think Tesla is going to deliver and by what year. And this is more or less what they've guided for. I have growth slowing down here a little bit past 2026. And this year, about 1.8 million cars delivered. Anyways, the point is we have to set a date, let's say 2026 in this case, and how many cars Tesla will sell in that year. The model says about 6.2 if Tesla follows their 50% long-term CAGR. I've modeled in 5 million cars. And with these assumptions on the left-hand side, with ASP being 47,000, margin being 18%, and that's actually a key point of distinction between the last time that we chatted, is Tesla's degradation of margin. Now, if you would have asked me back then, I would have said, well, if anything, Tesla's margins probably will flatline, if not go up, because of cost savings. And though costs did go down this quarter for Tesla, we still haven't seen that hit them just the operating line or the gross profit line just yet. Now, I'm still bullish that Tesla will increase margin from here with software revenues and just considering how high margin those are. But still, I think in terms of due diligence, it's probably fair to lower our margin expectations, at least for the next couple of years, and hopefully proven wrong on that. So margin at 18% and throwing a PE of 40, let's say, on Tesla, and we're looking at a long-term EPS growth of 50%. And remember, this is what Tesla guides for their revenue growth. And we'll talk about why PEG might not be the best and what we can substitute out for it. But that gets us to about $235 billion in revenue for the car business, about 40 some odd billion dollars worth of profit. Now, throwing that PE ratio, that multiple on that gets us to about a 1.7 trillion market cap. Now there's going to be dilution here. We have to discount this back, but that gets us to roughly about 360. Now you can play with these numbers if you want. You can bring it down to 15 and see how that affects it. These are all our assumptions that we're working with. And of course, no one knows what's actually going to happen. But as we continue to look on, I think the biggest distinction here is how little EPS is this year, right? If we talk, and I'll pull up this sheet now. This is my mega cap comparison sheet of NVIDIA, Apple, Amazon, Tesla, GM, and Ford towards the end there. And what people are expecting this year, and I've highlighted here, people are expecting about a $3 EPS this year for 2023. So $3 is what they're expecting on Tesla. Now, let's see where that ends up. But I think the last time that we chatted, I think estimates were about around the 5 or 6 level on Wall Street. All these numbers, by the way, are from the street. None of these are mine. So, if these are too low in your head, well, you could do your own adjusting here to see what you deem fit. But you'll see the street is only projecting a forward EPS CAGR, a forward EPS growth rate for the next 3 to 5 years of 25% on Tesla. Whereas if you go back to my sheet, if Tesla does, even $11, that's about, and this is not correct here, but that's about, I don't know, 50 to 60% EPS CAGR for the next few years. So, and I think I've jotted it down at $15. This number was about 70. So I think the street is massively under projecting what Tesla's EPS growth will be by the time 2026 hits. But albeit, we can calculate a peg for better or for worse and see where Tesla lays. Now, currently with the stock around 267 and EPS projected, EPS CAGR growth projected around 25% year over year. We get about a peg of, and of course, forward PE of 89. Then we get about a peg of 3.6. And remember, a greater than one peg is generally worse off. A lower number is generally better. So you'll see when Tesla was trading, and I'll quickly change this to at $100, you'll see how low the peg was for Tesla at that point, almost unsustainably low. And since then, we've seen a rebound in the stock price and therefore an increase of the peg. But you'll see when it stacks up to Amazon, actually, in a weird way, Tesla with the street numbers, with what the street is projecting, the street actually gives Amazon a lower peg because they think Amazon will actually outperform Tesla in terms of EPS growth for the next 3 to 5 years. Do you agree with that? Oh, you're just on mute. Oh, Herbert, you're just on mute.
Yeah, I do not agree with any of this, of course. So what you're showing me is just what the street is saying, right? And so, for example, obviously it looks like that this is just cars. It doesn't take into consideration FSD or bots or energy. And if you at that 25% earnings per share, the growth of the next few years, if you bumped that to 50%, what would happen to the peg?
Oh, it would half, right? So 25 to 50, a doubling of the EPS growth, half the peg. Yeah.
Okay. And that's with the current price of 267, right? Is that
correct?
Is that correct? Yeah.
That is
so
correct,
it just there's something off, obviously, for me. Everything here seems really off. Okay. And if you go back to your previous deck, to the previous thing, in the previous slide here, I got a little confused here. So just clarify for me. So what you're saying here is that if the what date were you saying that this price, if you do discounted cash flow, the price should be $400 if now, but you're looking at growth up to 2026?
Yeah. So what I'm doing is I'm setting a point in time in the future. In this case, it's 2026. I'm saying, what is Tesla doing in that fiscal year? And then I'm discounting that back and throwing a multiple on it.
Good. Okay. That's what I needed to know. So that's what it was, 2026. And you think at that point, the market cap should be $1.8 trillion based on kind of the growth of deliveries and then your price, ASP, and the margin. And that's where you're at with the market cap. Okay.
Yeah. And again, this is just auto. So I think that distinction is important. And also, not to throw a complete wrench into our conversation, but if robotaxis come out by then, I think this whole model is probably broken. And at that point, it's going to be completely nutty.
Got it. Okay, let's go back to the comparison. So again, this is just auto. You're doing forward. So that PE is forward PE, right? That's the part that gets me. That PEG ratio is based on forward PE.
Correct. Yeah. So Generally speaking, people that don't like peg say, "Well, who cares about historic numbers?
Yes,
Who cares
me.
about what Tesla?" Yeah, exactly. And I'm the completely same way. So what I've done in this case is I've created this forward peg almost, where I've taken
Okay,
the forward
thank you.
estimates and I've taken what Tesla is currently in terms of a stock price, and then I've done a kind of a forward peg based on that for all the mega caps. And again, this is using the streets estimates for each individual stock.
Yeah. Okay. So there's something wrong. There's something really wrong. I gotta say, this is what the streets are saying. It's clearly they're off. And so the first one is the growth. It's not going to be 25% growth. They're guiding if to 50% growth, especially since you also agree with that because you got the 20 million cars by 2030. And then this also take into consideration the different how they increase the TAM based on the Cybertruck, the Model 3 that's coming out, the Model 2, I mean the compact
Mhm.
car.
Yeah, well, I think the biggest thing with Tesla here is of course FSD is kind of the bomb that can happen at any point, and then
Yeah.
robotaxi, and we're talking about a different model. But also just with software revenue, let's forget about robotaxis for a hot second, and let's say Tesla continues to sell these cars at a lower profit margin each quarter. Great, but a year from now they launch a $99 per month subscription package that gets you 100 miles on supercharging networks. It
Mhm.
gets you, smart summon. It gets you lane change. It gets you these features that don't cost Tesla anything in terms of variable cost, because when they push out a software update, it's not like it's costing them something to do that, right? You download it over Wi-Fi, your car is the same, there's no parts. Well, now Tesla can make 99 bucks a month, 150 bucks a month, whatever they charge for this ongoing perpetuity, and it's all pretty much margin, right? When Tesla pushes this out eventually, and again, Tesla's probably not going to do this unless they think, okay, robotaxis is still a while away. But if they want to make some additional margin, it's an easy sell to the fleet to have a $99 per month package. And I bet you it would have a huge take rate. So immediately, Tesla has this lever that they could pull to increase their EPS should they want it.
Yeah. Exactly. So this is just I guess the base rate evaluation, just the cars alone. If you add the software, even just like you're saying, software for the cars, and then of course the potential big hits of other things. This earnings per share, is that auto, or is that
Yeah,
operational?
this is actually their 2023 estimates from straight from Yahoo Finance. So $3 is what
Yeah.
Tesla, the company, is expected to do this year fiscally.
And what is it next year? Do you know?
I think it's what, like $4 or something like that. I'd have to double check.
Hmm.
Yeah.
Okay.
So in terms of, here's the thing, right? As we talk about Tesla bulls, and this is just straight from the streets numbers, as we talk as Tesla bulls, obviously someone has to be wrong in this conversation that we're having. Either we're wrong and we don't think Tesla, and we think this growth story of Tesla, we talked about the operating leverage aspect of where, and by the way, I agree. I think that's where Tesla is currently on that chart, is they're at that operating leverage part where they're trying to lower and lower and lower their costs of their cars faster than they can actually lower price. And actually, I have a little a graphic here that I found on Twitter from Travis Hovium, and this is the Tesla's average cost per vehicle, and you can see sequentially it's fallen from the
Hmm.
peak of Q2 2022. So this is a good sign that Tesla is able to lower and lower and lower the prices that it costs them to make their cars. And I think as Giga Berlin, Giga Austin, Giga Mexico come online, ramp up fully, China less so because I think China's kind of hit its climax here for a little bit. I think the cost will continue to come down for Tesla on an average unit of a car. So there's a lot of confounding variables here when we talk about Tesla and what's going to happen next and who believes in what. And again, FSD really throws this all for kind of a tizzy, because if robotaxis come out at any point, then we're talking about modeling Tesla completely differently, because it'll everything else will kind of pale in comparison to it. But again, I think Tesla's story is far from over, and a lot of it still has to do with their AI and their FSD.
Right. Okay. So that's a very good point, right? So first of all, Tesla as um, right. You did look at forward PE, forward earnings, but the cost is not falling. And then we just launched Giga Berlin, Giga Austin. They're just ramping up still. Once they
Mhm.
get there, the 4680 batteries ramp up. There's going to be lots of opportunities to continue to bring the cost down. The margin, you kept it flat at 18%, and then you bumped it up to maybe 20%. What happens when you raise that even higher, getting back to where we were before? But of
Yeah.
course, like you said, confounding, because ASP is going to go down because you're going to introduce a lower price model, but it's still going to be 50% of the cost, 50% of the price. So we're still expecting the same margins, is what kind of they're hinting at, of what they're expecting it to happen.
Well,
um,
yeah.
and then, yeah, go ahead.
And I just look at Apple for a second, right? If you look at
Mm.
Apple's story of their financials, over the last 5 years, Apple Services has grown tremendously to a point where no one expected it to. Apple Services kind of came out of the blue. People said, "Well, is Apple really going to make money off their App Store? Like, who cares?" But here's the thing with stuff like AWS, for example, even AWS is a very small percentage of Amazon's revenue, but it's the majority of their earnings, and it's because it's high leverage, of course, because it's very high in margin. It's just software. That's all it is. When Amazon deploys out something, or Apple has an app that they let on their app store, and I buy it and I have transaction fees. It's not really costing Apple that much money, and that's the power of software. And so when we talk about Tesla, Tesla's computer is just a computer on wheels. Let's be honest, and they haven't even scratched the surface, in my opinion, of their potential earnings power with the software side. And everyone goes straight to FSD, and I agree that's so huge that we should talk about it. But let's just talk about App Store even for a second. And if Tesla launched an App Store, and I know that we've kind of chatted about App Store before and the potential there, just I even get giddy about something like that, even though that would pale in comparison to something like robotaxis.
Yeah. So clearly that's what you just showed is what the street's looking at. And it's you said, I love what you said, which is somebody has to be wrong, right? Either they're wrong or we're wrong of how we're viewing it. But the way you showed it was, I guess that's the way I see it, is what you showed is going to be the baseline, right? That's going to be the absolute baseline, which isn't bad. It's a fantastic story still. But I think it's going to be way more than that. Like you said, they're just completely underestimating where we're at. So let's go to this and show me what you're thinking. So this, oops, yeah, this Brian Feroldi, somebody I've been following on Twitter. He's been fantastic. He gives good financial advice. I don't know if you call it financial advice, but it's advice on how to be to look at how to properly do investments. And he's very very smart, right? He's very big on long term investments. And so he put this chart out, which I really loved, and it's wonderful. Basically, his point being that you can't use the same metrics to track a company's success or whether or not they're worth of investing in. Based, it depends on where the company is on their growth, right? So if you're a startup, then the green thing here, the metric you should be looking at is total addressable market. And then maybe you might look at price of sales. If they started to make any sales at all, you'll look at price of sales and price to earnings power. Those are the metrics you would use. Of course, you wouldn't use discounted cash flow because you really don't know yet where the future is going to hold. It's still too early. You wouldn't look at these kind of metrics down here. Okay, and that makes sense. Then when you're in hyper growth, price of sales is what's going to be the big one. Then
Mhm.
as you get to self funding, you're able to you're starting to get profitable, you can look at the price to gross profits. You can look at the price to earnings power. Those are things. Okay, that makes sense. So what he says, his opinion is that Tesla is in operating leverage number 4. And he said that
Mhm.
it depends if you think it's in the early part of operating leverage or in the late part of operating leverage. But these are the measures that you should be looking at if it's Tesla, he said, right? So price to earnings power, reverse discounted cash flow, which is what you were using, the earnings yield, and then price to forward earnings. Thank you very much. You did that as well. And then price to free cash flow. So that's another thing to look at because, Tesla is going to be a cash flow machine. But so when you and I talked about this earlier, I kind of agreed, which is, do you actually see this Tesla being here, number 4? Or is it like some businesses are number 4, like the auto business, but there's other
Yeah.
startups that they're doing that's like it's going to be additive to this. And so you
Mhm.
can't, what we just saw was 100% auto. And the auto is going to be great, but you can't be confused to think that Tesla is just auto. So tell me about what you saw when you see this chart. What do you think?
Yeah, I think you nailed it. So there's different aspects of or different segments of Tesla's business that are in different stages here that I see. The auto business, I agree. I think it's probably in the beginning part of the operating leverage story. I mean, Martin Vieca has pretty much confirmed this more or less. He said, "Look, don't worry about gross margin. Worry about operating the operating line for us moving forward for the car business." And I think that's fair because Tesla, it's not like Tesla doesn't know how to make cars at this point, right? Maybe if you asked 5 years ago, they'd kind of have questions about how they're going to ramp and all this stuff. Now it's like, okay, they have the blueprint. How can they replicate it and refine it so costs continue to go down even more? So that's why I think it's an operating leverage story. When you talk about something like Tesla Energy, I still think they're in hyper growth when we talk about
Yeah.
battery storage.
Nice.
When you talk about something like Tesla Bot, so that's a
Yeah.
startup still, right? We talk about addressable market when we evaluate that. When you talk about FSD, that one's a little bit tough because monetarily, probably a different answer than progression of the actual software and where they're at. I think FSD is an interesting one where they can go from kind of 1 to 5 very fast because they can just launch something, have fleets out, and then all of a sudden start returning capital massively. So in stage 5, for example. So and that's what makes Tesla so exciting is that there's different aspects that we could talk about, and they're all in different stages of where it is on that chart, for example.
Nice. Okay, that's exactly what I was hoping for. So, um, and then the other thing what you just touched on, which makes sense, is that the unique thing about Tesla is that they're an innovation company. They keep creating businesses and markets just left, right, and center, and these things take off. And part of the reason they take off is because they leverage off of the infrastructure, the factories, the humans, the smart people that they already have. They leverage off the technologies that other divisions are doing it, and they use that. And so for them to launch a new business that's not hampered by the typical expenses, like it's really really hard for a new startup
Yeah.
to create a car uh, or to create what was a good example that they give, like a new startup trying to do is it FSD? Yeah, because you don't have the existing business model where you're
Yeah.
already making money on this case the cars.
Yeah.
What do you do, right? You have to invest so
Mhm.
much to support that. Everything's brand new, all expenses.
Exactly.
Okay,
Yeah.
so what's your opinion? Tell me just high level. So you showed me what you're looking at, and you did bring down your price point of what you think the price is of Tesla today. You initially were saying 440 last year, but because of margin compression, you bring it down to 380. Is that what you said?
Yeah, you know what? I'm even hard pressed to give an exact number because I don't look at price targets that way a little bit. I'm not like an analyst where I have, okay, this is my set for
Right.
that time. I kind of play around with the model. I really try to fine tune the modeling because the variables can always change and everyone's going to disagree with the variables that I put in. You might even, of course. So I just look at the model and I go, okay, like let's stress test this a little bit and go, okay, like if margins come back down to 15%, where are they at? If they go up to 25%, where are they at? So it's hard. I don't even put a hard line number on it. I just look at it. Okay, well, Tesla's sitting at $260 as we talk. Do I think Tesla there is value here in Tesla massively so just for the auto business? And if the answer is yes, then well, what about energy? What about FSD? What about Dojo? What about, all this sort of stuff? So Tesla's and some people call it like the free option call, right? If you believe in Tesla Auto, great. You can believe in the car business, and then you get all these other businesses for free. Is kind of what people look at it like. But I even just with the AI boom that we've seen recently, now with the room temperature super processor rumors going out there, which I'm not sure if they're going to pan out. It just seems like the future is so bright. If anyone is positioned to take massive advantage over this next big AI boom, I think it's Tesla. So that's the way I almost justify it in my head. But again, these models can always change.
Hey there, thank you for joining me. If you can, please consider supporting this channel so I can keep it going. It's a lot of work arranging all these amazing interviews. One of the easiest ways is just to click that join button and become a member of the channel. Thank you very much. Let's get brighter. Okay, so let's explain to folks. I saw this nice table here for this. Brian Fulroldi is explaining that most of us, and I specifically, use the PEG ratio. That's what I really like. I think that because the PEG ratio takes into account the growth of a company, and if it's the future that matters, not the present. Where's this going to go? And so that's why I prefer the PEG ratio over the PE only. Okay, so just the history is that Peter Lynch was the one who loved the PEG ratio. He popularized it and went up on Wall Street. But this guy says the PEG ratio actually sucks. And again, the answer is it depends on where you are on the stage of the company you're at. And so what he had said was if it's one, PEG is one, it's fairly valued. If it's over one, it's overvalued. And if it's under one, it's undervalued. So that's how you typically look at the PE, the PEG ratio. And so the pros are it's easy, it's fast to calculate, factors in growth. But the negatives
Mhm.
what's your earnings may be wrong, the growth estimate's wrong, which I think is what's happened here with Tesla.
Right.
All of that was wrong, and it doesn't account for the mode size, right? That's exactly the whole point here. All the things you just mentioned, which is at any point, all these other technologies is going to come and become very sizable, very quick. Dividends, earnings quality, management quality, which is again, Tesla's an innovation company. And so you got to like, don't just look at the PEG ratio. It's like, do you think that Amazon, even though it's got a better PEG ratio, is going to innovate as much as Tesla will in the next few years and the cash
Mhm.
and the debt that they have to protect? Yeah. Do you have any comments on the last two slides?
No, I generally agree, but it's kind of like we have to use what we have, right? As retail investors, there's only so many financial tools we can get. I think we can do stuff like use forward EPS growth. We can factor in our estimates instead. We can discount a little bit higher if we have to. But I generally agree it's tough to evaluate just based on PEG. But I think just to be intellectually honest, 6 months ago when Tesla was trading at 100, we're all staring at the PEG and going, "How is this possible?" I think now that Tesla's doubled really since we've talked last, more than, we have to also be intellectually honest and go, okay, well, the peg now using those same growth numbers shows Tesla at a way higher peg. So what is going to change here, if anything? Or do we think our growth estimates have to go up here, or do we think the peg has to come back down?
Well, so I guess I have to counter what you just said.
Okay,
You said,
do it.
the price doubled. Yeah, but the price fell from 400 to 100. Okay.
Yeah.
And so it's like we're just getting back to where we were. Now, the question is, why was it valued at $400,
Mhm.
$423, which is its all-time high at one point? It clearly was overvalued. I'm not saying it wasn't overvalued, but it's all about the future, right? You're investing in a company based on the future.
Mhm.
So the growth prospect, and so if you look at where it was a year and a half ago, that's when it was at its all-time high. Every milestone, Tesla's hitting every milestone. We now have two new gigafactories. We got another gigafactory being built. We have mega pack factories. Everything has been as predicted is happening. The only thing that I think was not predicted was the price cuts because of the macro, and the macro was severe last year. And so this whole thing about the earnings only being $6, and so now I'm going to go forward it. Well, you got to overlay the macro. The sales might go through the roof because imagine if the sales are still at 50% growth during a massive interest rate hike period. People getting afraid, socking away their money, and then we still achieve so much. The company is still incredibly well positioned. So,
Mhm.
like it was a very odd 2 years that this happened when it fell from an all-time high. So I'm not saying we should be back at 400. I think that was over exuberance. I think that there was money flowing, but we're certainly not worth 300 right now. We're worth way more than that. And then I look at the future. So I'm very, very excited about the future. I think that it's totally underestimated. Uh, you know, in everything, including auto GM and auto prices. And now that you have the Cybertruck, you have the Model 3 coming, the Model 2 coming out. Um, this is going to massively improve the TAMs, and I think that the Model Y and even the Model 3 it's being going to be revised. It's going to have massive growth still, um, globally, globally. So
Mhm.
yeah.
Here's what I would say to that. I would say, okay, when Tesla was at all-time highs, October 2021, gross margins were way higher than where we're sitting at right now. And I almost look at obviously gross margins as like a padding for downside risk. If there's a recession, if there's some sort of liquidity event, you have enough leeway, enough padding to lower prices and still make money. Tesla, in my opinion, obviously has used up not all of it, but has used up a decent chunk of that gross margin to drive volumes. And now where Tesla sits at, it's almost like the street looks at Tesla and goes, does Tesla, can Tesla ever get back to that margin? And they're looking at it and I think it's almost undecided. I would think 50% of them think no, we've seen the max, the cap of what Tesla margins could have ever been, and they're never going to get back to that level. And I think there's some people on the street that go, okay, well, and the Kathy Woods of the world, the Pierre Fairgou's of the world that go, these margins that we saw in 2021 for Tesla, those are just the beginning, and they're going to be surpassed one day past, let's say, 30% Apple like margins. So I think there's this dichotomy, this spread out thinking on the street on Tesla and where the margin story is. Yes, Cybertruck's coming out. Super excited about it. I think that'll have a big effect on TAM and the perception of Tesla. I agree. But I think the key story here with Tesla on the auto business is and will be margins, and therefore either cost reductions or price upticks. So increases in ASP. One of those two things I think has to happen here for the street to then again believe that Tesla's margin story is still not over. And again, going back to our conversation, software can come out at any point and just mute this whole conversation, because it can have a 500 basis point hike on margins if there's enough of a take rate off something. So I think that's where the
Yeah.
street's at.
Yeah. So I think, okay, so this is very, very incredible year. It's just a weird, really weird year, right? Because we had the inflation and macro. And then you had Tesla's strategy. And their strategy was to reduce the prices to to be able to sell more to hit their growth. Okay. And then
Mhm,
what Elon and Tesla's been saying over and over again is that we're taking a hit on margins, but like you just said, when FSD comes, they're going to have such more of a volume out there that they're going to be able to just turn that on and get catch up on margins at that point, right? So that
mhm,
was their strategy, and so and then the other thing that it did was it basically just completely changed the landscape, the competitive landscape. We've got companies that are about to die now. They're now partnering with Tesla because they're in the ropes. They're struggling. When you lower the prices, all of a sudden the others can't make their money, which they needed to have in order to, because they were earlier in the stage of trying to create their new startup, the EV world. And so
mhm.
now it's like short-term pain for massive long-term gain. 3 5 years from now, you might not have several of these competitors out there. It could just be an open field for Tesla. Tesla's prices are so low that they can just sell so much more. Then they're going to add more margin because of the software and so forth. So that's the story I think people need to believe. So for Tesla to be at this point now, so I think it's completely undervalued, because when I invest, I always think that the price should reflect what it's going to be in the future. And that's why I'm glad that it's low now, because I'll invest. But since I've already invested, I'm like looking at this going, yeah, it's like people are not seeing the story here. This thing is worth way more than $300. I mean, so tell me, what do you think is your estimate? Like, where do you think that what market cap do you think Tesla deserves today, and where do you think it will be? When will it surpass Apple?
Oh, okay, that's now, yeah, like now we've opened up a
Mm,
really exciting conversation, because it's like, okay, Elon says Apple, Saudi Aramco combined. Here's the thing, and I'm glad you brought up Apple specifically, because I harp on this point a lot and I get a lot of hate for it. Apple, for Tesla to pass Apple in market cap, forget about the years. I think they need to implement buybacks sooner rather than later. The
yeah, I
reason
agree.
why Apple, yeah, you agree. That's great. And so Apple is where Apple's at because of their corporate strategy. They do
Yes.
buybacks. Yes, they have
Yeah.
dividends, and because they're a cash cow now. But forget about dividends for a second. Buybacks need to happen. They need to lower their float. That's how Apple gets to where they're at.
Yes.
Now, if Tesla doesn't implement some sort of a buyback strategy, I think they're going to be hard pressed to increase that market cap in lieu of FSD in the immediate 2 or 3, in either 1 to 3 years. Now, long term, everything's off the table with Tesla, and any sort of innovation can take a massive hockey stick curve out. But I think for to get that sort of market cap that Saudi Aramco, Apple combined, I think they need to implement buybacks. Um, but at the same time, like, Apple could just come back down, right? Apple is a very strong stock. They're kind of like the cash equivalent for kind of all tech investors out there. Instead of putting in cash, just put your money into Apple is kind of what people think. Steady Eddie sort of stock. Tesla is not that stock yet. They're very Tesla is very volatile, as we know, and at the same time, that's why I love Tesla, is because there's so much innovation here that could potentially happen. Whereas I don't know how much innovation is left in Apple. So to answer your question in a roundabout long way and to avoid it almost, is to say, well, if Tesla announces buybacks and has some sort of corporate strategy to do that, then of course, I think in the next 3 to 5 years, we're kind of looking at that Saudi Aramco Apple moment. Does that mean FSD has to happen? Probably. But again, I wouldn't put anything past Tesla bot even at this point.
Exactly. Okay. So So I do agree with you that the reason Apple stock has risen so much, and specifically in the last 10, 12 years, is because of buybacks. And so when they buy back, they reduce the float, the shareholding float. And so the price per share goes up, right? It's like it makes the earnings per share go up just because of sheer cash that they have to be able to buy the stock back. And
Yeah.
so Tesla is going to be just hemorrhaging in cash. Their cash float at 22, cash balance at 22 billion, 23 billion right now. It's going to
Mhm.
just grow significantly as the company grows. And so they cannot build 3 factories, 5 factories all at the same time. They can only
Yeah.
do 2 at a time, maybe 3 at a time max. Now that they add bots, which cost nothing comparatively to a car, less than 10 grand to build a bot. In fact, even probably cheaper as they mass produce this thing, and then
Mhm.
the bots just revolutionize how you create products. They're going to be floating in cash, and so that's I'm definitely looking forward to them, and I do expect that they'll do this. But like you said, it's like a corporate strategy.
Yes. Yeah.
It's a corporate kind of manipulation of the stock price, the
Yeah.
market cap of the company.
And to be fair, Elon said, like, look, we're fine. He like I think people forget. He said last year, I don't care if recession happens, even probably the worst of times, we can probably
Right.
still do 5 billion. And he was careful to stop himself and say, but look, obviously the board has to approve it. Like he didn't want to sway them. But let's be honest, if Elon says for the board to do something, when was the
Yeah.
last time that they disagreed with him, right? At least publicly. So whatever Elon says probably goes. And Elon says, look, even in the worst of scenarios, we probably can still do a $5 billion buyback next year. And again, 5 billion isn't consequential when we look at like Google and Apple doing like these 30, 40, 50 billion dollar share buyback programs. But again, Tesla has to start somewhere. And I think buybacks are a really good confidence boost for investors on the street, even to look at Tesla and go, wow, they're printing so much money that they're buying back the stock. It's the opposite effect that we saw in 2020 when they raised all this money, right? Multiple times. It's like they're giving it back now and they're saying, we think our shares are too underappreciated for where they are long term. So I think, and again, we're going to get comments on this video. Guarantee people are going to say, Yash, Herbert, Tesla should not buy back. They need all the cash they possibly can use to build new factories, everything, the amount of capex that they have. But Elon's on the record to say, look, we have enough cash. We have so much cash that
Yeah.
we don't know what to
Yeah.
do with it.
Yep.
Our limiting factor is finding people. It's not about the cash at this point.
Yep, and you can sell it back and get it back anytime you want to. But anyways, I'm not. I do disagree though that you need to do Tesla needs to do buybacks in order to be bigger market cap than Apple aside Aramco. I don't think they need to do that So
Okay.
I think that they're going to be able to generate, and it's looking like every business that we're talking about that was a option play is no longer an option play. They're all real
Mm,
businesses. Energy is now a real business generating significant profit. And it's just at the very, very beginning. We're going to see this thing
mhm.
double and triple and quadruple in the next several years. Then you've got the bot, which is a real business now. I mean, I know we called it a startup, and I agree with you, but at the end of the day, look at this. They're going to be able to, we knowing the resources that Tesla has today, where they've achieved this at, that they're leveraging the FSD brain to be able to try to manage this thing, that it can already pick an apple and know which is the apple, and then do all these things. And so it's already going to be very useful. And part of that discussion about it being leveraged, if you were a bot company and you're trying to create your own new bot, who do you sell it to? You need to find customers to buy it from you. But Tesla
Right.
won't have to sell it to anybody. They just use it themselves, and they automatically there's the expense savings is worth it's more than what they could have sold it for,
Mm.
to another company. So they're going to be able to take advantage of that right away and generate margins. So yeah, just everything that Tesla's doing, like you said, FSD, even just FSD take rate. Let's say robotaxi never happens, but the take rate keeps going up because it gets better and better and better and becomes more of an ADAS system. So all of
Mhm.
these things are so powerful. I just think that even without buybacks, the stock and the world is our oyster.
Well,
So
I actually disagree with Tashakini that you did an interview with, and I actually side with you because you said, well, I think Tesla bot is actually, if you think about it, a little bit easier. to manufacture and to deploy. And she made a really good argument. She said, well, there's less variables and there's less rules when it comes to bots. With at least cars, there are specific rules you have to follow. But the thing with the bot that I agree with you about is that Tesla has all the learning, and all the self-labeling. They have all the occupancy networks. So when they deploy this bot out, if they just narrow down the scope of what they needed this bot to do to a handful of things, not pick and pack even, but even a little bit more, then yeah, I agree. These cost savings can be massive for Tesla, and then they can even lease these out to manufacturers on, on manufacturing lines or whatever it might be. It's very dystopian almost if you think about it. And I agree. Like the cost savings that Tesla has, they're their own customer, and that's what makes it unique. And the vertical integration that Tesla has, it almost like every time I think about it, I almost like stop and go, it almost like how many years until Tesla gets hit with one of those Google monopoly,
Yeah,
things
yeah.
from the government? Like, how Google every so often
Yep,
from the from the EU gets hit with like,
yep.
they're almost too big for their own good type of lawsuits. How big until it, or how many years until Tesla gets hit with one of those? It feels like,
There's just the bot business alone is going to be bigger than Apple and Saudi Aramco, the next 50 companies.
yeah,
It's like it's crazy big of a business, and so it's like it behooves Tesla to actually, just spend all their time and effort on the bots and less effort on the cars, or
yeah.
because everything that the bot does, as you improve the bot, it will improve every business that you're working on. Everything.
Hmm.
It will
And I
improve
think
everything.
we should also preface this entire thing and wrap it around that. Well, there's a lot of execution that Tesla still needs to do, and
Yeah.
that's what differentiates, I think, Tesla both from the street. That's a little bit more skeptical. Is, we think if anyone can do it, it's Tesla and their team. But the execution still lies ahead for Tesla to do. But that's what makes it exciting, because I don't know any other company that's even trying to tackle problems like this.
Okay. Thank you so much, Yashu. Yeah, I've been calling Tesla an execution machine and an innovation machine. I mean, they've hit it out of the park. They create the best factories. There's everything that they say they're going to do. They create. It just takes time, but then it happens. Okay.
Yeah,
Thank you, Yashu. That was a lot of fun. Appreciate you joining me. Thanks,
right
everybody.
on. Thanks for having me, Herbert. Everyone, subscribe to Herbert's channel down below.
Yeah, and also, yeah, yeah. Sorry, Yashu has his own YouTube channel called Hit
Don't worry
That
about it.
Bid. You subscribe to him, you can see these kinds of analysis that he does. Quite smart. Thank you. Bye, everybody.
Right on.